A lot of people don't invest because they're scared of picking the wrong thing and ruining their future. I get it. There are too many choices, and it's hard to know where to even start. When you're beginning from zero, one wrong move feels huge. But if I had to rebuild my entire portfolio in 2026, there are only 3 ETFs I'd trust, and each one solves a problem beginners struggle with every day. In this video, I'm walking you and Josh through the exact 3 ETFs I'd use if I had to start from scratch. You'll see what each one does, why they work so well together, and how this simple mix can become a portfolio you actually stay consistent with. And in the end, I will show you and Josh how a straightforward $10 a day habit in the 3 ETF portfolio can grow into a $1 million portfolio. Before we jump into the ETFs themselves, let's get on the same page about something important. A lot of people see investing as confusing. They imagine fast charts, complicated strategies, and decisions only financial experts could possibly understand. And not to mention the gazillion options to invest in. No wonder so many people hesitate before they even begin. But building wealth doesn't come from complexity. It comes from clarity. The simpler your approach is, the easier it becomes to stick with it. And that consistency is what actually moves your money forward. If you look at investors who've built real long-term success, they usually share the same philosophy. Keep things simple. Simple is definitely not exciting, but it works. When you're not stressing about predictions or chasing whatever stock is trending, you finally give yourself space to make steady progress. So if simplicity is the edge, what's the simplest tool that gives you diversification, growth, and peace of mind? That's where ETFs come in. An ETF is basically a basket of companies you buy in one step. Instead of picking individual stocks, you own pieces of many businesses at once. It spreads out your risk, reduces decision fatigue, and removes the pressure to guess which company will outperform next. It's one of the easiest ways to start investing without feeling overwhelmed. And behind every great ETF strategy are 3 principles that make the whole thing work. The first is dividends. A dividend is simply a small portion of a company's profits that gets paid out to you as an investor. That's it. When a company makes money, it shares a piece of that earnings with the people who own its stock. And when you take those dividends and reinvest them, your share count grows. More shares means more dividends, and that cycle is what creates long-term compounding. It starts slow, but over the years it becomes surprisingly powerful. The second is consistency. Most people think timing matters more than anything, but consistent investing at regular intervals almost always beats trying to predict peaks and dips. The third principle is quality. Great companies often look expensive because they're actually winning. ETFs make it easy to own those businesses without needing to research every detail yourself. Now that we're on the same page, let's talk about something most beginners never realize. Not every company gets a free pass into an ETF. There's a whole filtering system running in the background. It decides which companies get added, which get removed, and which never make it in at all. Once you understand how this works, ETFs stop feeling mysterious and start feeling like a smart built-in quality check. The first filter is size and stability. That simply means ETFs look for companies that are big enough, established enough, and traded often enough to be reliable. This instantly removes tiny or unstable companies that could introduce unnecessary risk. The next filter is financial health. At a basic level, financial health is just a company's ability to make money, manage debt, and keep its business running smoothly. ETFs use rules to screen for strong cash flow, steady earnings, and business models that aren't falling apart. You don't have to read balance sheets yourself. The ETF does the heavy lifting. Then comes competitive strength. This is about how well a company can hold its position in the market. Leaders usually stay leaders because they have pricing power, loyal customers, solid margins, or products people rely on every day. If a company starts losing that edge, it eventually gets replaced by one that's performing better. And that brings us to rebalancing. This is just the ETF's way of refreshing itself on a set schedule. Sometimes it's quarterly, sometimes yearly. If a company slips, it gets swapped out. If a new winner rises, it gets added in. Without doing anything yourself, you end up owning stronger companies over time. Now that you know the rules behind the system, let's look at the first ETF that holds this whole plan together, the Schwab US Dividend Equity ETF, SCHD. When you're starting from zero, the first thing you want in your portfolio is something steady, something that doesn't rely on hype, predictions, or the latest market trend. That's exactly why SCHD sits at the center of this plan. It gives your portfolio a backbone and keeps everything grounded in an unpredictable market. SCHD tracks the Dividend 100 Index, which is basically a group of large US companies with long, dependable histories of paying dividends. But SCHD doesn't stop at simply finding companies that pay. It screens for quality too. It looks for strong balance sheets, solid cash flow, reliable earnings, and companies that consistently grow their dividends over time. In simple terms, it picks businesses that have the financial strength to keep paying you year after year. Take companies like Coca-Cola, Pepsi, AbbVie, Cisco, and Merck. These aren't flashy names that double in value overnight, but they're dependable. They sell products that people buy in any economy. They generate real profits. And they have decades of keeping shareholders rewarded. That's the kind of consistency you want when rebuilding from scratch. One of the biggest reasons SCHD works so well is its dividend profile. The yield typically sits at 3.73%, which means you're getting paid above the market median just for owning it. But the real strength isn't the dividend itself, it's the growth. SCHD has a strong history of increasing its dividend payouts, averaging over 10%. And when you reinvest those dividends, your share count grows. More shares means more dividends, and more dividends buy even more shares. That's the compounding snowball. Another underrated advantage is how SCHD fits the current environment. If interest rates stay higher for longer, and that's a realistic possibility, investors naturally look toward companies that produce steady cash flow instead of relying purely on growth stories. SCHD is built to thrive in that kind of world. It leans toward value, quality, and durability, which helps smooth out the bumps during market uncertainty. There's also the tax angle. Many of SCHD's dividends qualify for lower tax rates, and if you hold it in a tax-advantaged account, that income compounds without you owing anything until much later, or even not at all, depending on the account type. SCHD doesn't try to impress you with big jumps or dramatic headlines. It wins by being reliable, predictable, and consistent. And when you're building a portfolio from scratch, that's exactly the kind of foundation you want. Now that you have a foundation in place, the next step is adding something that captures the broader growth of the US market. That's where the second ETF, the Vanguard S&P 500 ETF, VOO, comes in. After VOO, I will show you one more ETF for the 3 ETF portfolio, and in the end, I will show you and Josh how a straightforward $10 a day habit in that portfolio can grow into a $1 million portfolio. But first, let's see VOO. This is the ETF that gives you exposure to the backbone of the US economy. It tracks the S&P 500, which is basically a list of the 500 strongest companies based on size, stability, and financial health. These are businesses like Apple, Microsoft, Nvidia, Amazon, Meta, and Alphabet, companies with real products, massive customer bases, and long histories of driving growth. But it's not just tech. You're also getting healthcare, consumer goods, energy, finance, and more. It's the entire US economy packaged into one simple investment. One of the biggest advantages of VOO is how little it costs to own. The expense ratio is only 0.03%, which means if you invested $10,000, you'd pay about $3 per year for management. That's less than the price of a single cup of coffee. And what you get in return is access to some of the strongest and most profitable companies on earth. Low fees matter more than people realize. Every dollar you don't spend stays in your investment and keeps compounding for you. Another thing that makes VOO special is how it naturally adapts to economic trends. The S&P 500 is weighted by market size, meaning the companies that perform well take up a larger share over time. You don't have to manually adjust anything. The index leans toward the winners automatically. If a company grows and stays strong, its position increases. If it struggles or declines, it shrinks or gets removed. You benefit from the natural survival of the fittest happening inside the index. Historically, VOO has delivered strong long-term returns. The exact number changes depending on the period, but over many decades, the S&P 500 has averaged roughly 10% per year. Through recessions, wars, inflation spikes, and tech booms, the long-term trend has been the same: steady upward progress. That doesn't mean every year is great. Some years are rough, some years explode upward, but the long-term trajectory has always rewarded patience. And that's where VOO shines in this plan. You're not trying to outsmart the market or chase trends. You're simply buying into the economic engine of the United States, trusting that over time, great companies will keep growing. Whether the headlines are positive or negative, VOO keeps representing the most resilient businesses, the most profitable sectors, and the companies driving the country forward. Combined with SCHD, VOO gives you both stability and long-term compounding, a powerful mix when you're starting from zero. But there's one more layer that adds something special: innovation. And that's where the Invesco QQQ Trust ETF, better known as QQQ, comes in. It is the piece that adds real acceleration. This ETF gives you access to the companies shaping the future, building the tools, technology, and platforms we'll rely on for the next decade and beyond. QQQ tracks the NASDAQ 100, which includes the 100 largest non-financial companies listed on the NASDAQ exchange. These companies are pushing boundaries in artificial intelligence, cloud computing, chips, digital advertising, electric vehicles, and biotechnology. They solve big problems, serve massive markets, and constantly invest in creating what comes next. Apple, Microsoft, Nvidia, Amazon, Meta, Tesla, and Broadcom sit at the top of QQQ with much higher weightings than they have in VOO. They have massive customer bases, strong competitive advantages, and research budgets big enough to keep pushing innovation forward. Nvidia powers AI chips. Microsoft and Amazon run the cloud. Apple shapes consumer tech. Meta pushes digital platforms. Because of that, QQQ has historically delivered higher returns than most broad market funds. Over long stretches, it has outperformed the S&P 500 by a wide margin. The trade-off, of course, is volatility. QQQ moves faster in both directions. When the market is excited about tech, it can climb very quickly. When tech hits a rough patch, it can fall harder too. Another thing most people don't know is how consistently profitable the companies inside QQQ tend to be. Many of them generate some of the highest returns on invested capital in the entire world. That means when they reinvest money back into their businesses, they often generate more growth than average companies can. That's part of why QQQ has such strong long-term performance. The businesses inside it use their resources more efficiently. There's also a structural note worth mentioning. QQQ currently operates as a unit investment trust, which limits how much it can rebalance or adjust. But there has been discussion about converting it into a traditional ETF, which would allow even greater flexibility and possibly lower fees. Even without that change, the fund remains one of the most efficient and well-known ways to own the front edge of the economy. QQQ isn't meant to stabilize your portfolio. SCHD handles that. And it isn't meant to represent the entire market. VOO already covers that. QQQ exists for one reason: to give you exposure to the companies that are driving the next wave of innovation. When you're rebuilding from zero, having a slice of the future can make a huge difference over time. Now that we've covered stability, broad growth, and innovation, let's bring everything together into one simple allocation strategy. I'm allocating 70% to SCHD, 15% to VOO, and 15% to QQQ. It's the simplest way to cover stability, growth, and innovation without overthinking. SCHD holds the largest share because it provides the foundation. With a 3.73% dividend yield, 10.43% dividend growth, and 7.9% annual share price appreciation, it delivers steady income and reliable performance. This portion keeps the portfolio stable during volatile periods. VOO sits at 15% to capture broad U.S. market growth. Its 1.12% yield, 6.17% dividend growth, and 12.76% annual appreciation give you consistent exposure to the strongest companies across the entire economy without needing to pick sectors or winners. QQQ rounds out the final 15% for innovation-driven upside. Even with a lower 0.45% yield, it offsets that with 9.45% dividend growth and a high 18.49% annual appreciation, reflecting the strength of the leading tech and growth companies inside it. Together, this allocation produces a blended 2.85% yield, 9.64% dividend growth, and 10.22% annual appreciation. So, how does this mix hold up in different market conditions? Every market cycle looks a little different, and that's exactly why this 3 ETF setup works so well. SCHD tends to shine when things get choppy or when interest rates stay higher because strong cash flow companies remain in demand. VOO performs best during steady economic growth, capturing the momentum of the overall US market, and QQQ leads during innovation cycles, especially when technology and AI breakthroughs dominate the headlines. The key is that no single ETF has to do all the work. Each one steps up in different seasons, giving your portfolio balance, stability, and resilience over the long run. To see what this 3 ETF plan can build over time, imagine Josh starting this year and investing $10 a day. By the end of year 1, he would have invested about $3,650. By year 10, the portfolio grows to roughly $67,000, and annual dividends reach around $2,000. By year 20, the acceleration becomes hard to ignore. The balance rises to about $291,000 and yearly dividends climb to around $7,000. And by year 30, the long-term impact is obvious. That same $10 a day habit grows into a portfolio of about $1,028,000, generating roughly $22,000 a year in dividends. If you could only invest in one index fund, just one, that has the potential to turn $10 into a $2.2 million portfolio and pay over $6,000 a month in dividend income, click the video on your screen to find out which one it is.